Hello and welcome back to our channel. Today's agenda is to understand accounting for the acquisitions, and this time we have come up with another important accounting standard, namely IFRS 3 business combinations. Starting off with the definition of IFRS 3. So, IFRS 3 deals with how an entity accounts for a business transaction in which it obtains control over another business. So, you see the keywords here are business and control. If both exist, then IFRS 3 applies. IFRS 3 also gives us a definition of business. What is business? Business is an integrated set of activities. What are those integrated activities? That is input, process, and these two are then used to generate output. An integrated set of activities and assets that is capable of providing goods or services to customers, generating income from the ordinary activities. Ordinary activities, the basis on the which, like, the primary function of business, the primary activity of a business. So also it defines business combination for us. What is business combination? A transaction or other event in which an acquirer obtains control of another business, that is named as acquiree. So you see, acquirer and acquiree, these two are the terms which will be used excessively in the upcoming slides, so keep them in mind. And how do we take an example for it? That A Limited acquired 70% shares of B Limited. So you see, excess control has been given to A, so it gains control, and this transaction is called business combination. Okay, so the main objective of IFRS 3 is to ensure that when a business combination happens, the financial statements provide useful and transparent information. The standard wants users to understand what business was acquired, how much was paid, what assets and liabilities were received, and how goodwill was calculated. In simple words, IFRS 3 wants financial statements to clearly show the economic reality of the acquisition and not just the legal form. Okay, so IFRS 3 applies. Let's understand the scope of IFRS 3. So it applies when one entity obtains control over another business, and this includes acquisitions, mergers, takeovers, step acquisitions, or business combination achieved in stages. Also, it is called that. The moment control is achieved, IFRS 3 becomes mandatory. And IFRS 3 does not apply to acquisition of assets that do not form a business, formation of joint arrangements named as joint venture, which is one type of it, and also transactions under common control or combinations under common control. So these it, that does not constitute IFRS 3. Okay, now IFRS 3 applies or allows only one accounting method for it, and that is called the acquisition method. So there is no choice given to the companies in this regard. Every business combination in accordance with IFRS 3 must follow this acquisition method. Okay, now what we will do, we will discuss each of these 5 steps in detail. The first step is to identify the acquirer. Okay, so who is the acquirer? The acquirer is the entity that obtains control over another entity, and that entity is called the acquiree. What control means? Control usually means that the acquirer has power over relevant activities, means he has the power to direct relevant activities of another business, such as operational and financial activities. It is exposed to variable returns. It means that income of the acquiree will vary, so your returns will also vary. For example, the best example of this is the dividends received from the acquiry. And also, third point, it has the ability to use that power to affect the returns. So these three are must for an acquirer to have control. So in simple words, the company that makes major decisions is the acquirer. Okay, second step, it is to identify the acquisition date. So the date on which the acquirer obtains control of an acquiry. The acquisition date is the date on which the acquirer actually gains control. Date from which acquisition accounting begins. Date on which goodwill is calculated. Date on which fair values are calculated. So, this date is important because, like I told you, fair values are measured on this date, assets and liabilities are recognized from this date. So, everything is locked at acquisition date values. Example, like you purchased majority shares of one firm on 1st July, you obtained control, so acquisition date would be 1st July. Okay, now let's look at one example of it. So you see, company A acquired 80% equity trust in company B for cash consideration, and the relevant dates are as under. You see, date of shareholder agreement June 1, appointed date as per shareholder agreement April 1, date of obtaining control over the board presentation July 1, date of payment of consideration July 15, date of transfer of shares to company A August 1. So according to you, what would be the acquisition date? So like initially I told you that keywords are business and control in IFRS 3. So when is company A acquiring control? That is July 1. So acquisition date would be July 1. Okay, let's go to the next step. Consideration transferred. So what is consideration transferred? It means what the acquirer gives to obtain control. And now this can include cash, shares, assets, or any contingent consideration. The sum of all of these constitutes the consideration transferred. So one important and different term here is contingent consideration. So what is contingent consideration, such as profit target or sales target? How? So look at an example. Okay, you see, there is a company A and it decides that if it earns 100 crore of profit when it acquires company B, so it will pay additional 20 crore consideration to B. So this is subject to some condition. So you see, this is contingent consideration. So what will happen? It will calculate or add fair value of this this contingent consideration in its sum transferred. So you see, all consideration including contingent is made at fair value on acquisition date and not the book value. I hope you understood the example. Okay, moving forward to step 4. So at acquisition date, the acquirer must recognize what all identifiable assets required, all identifiable liabilities assumed, and any non controlling interest in the acquiry. So, what is non controlling interest? It is that part of the company which is not bought by the parent, which is not under the control of the acquirer. So, you see, the important rule here is that assets and liabilities are recognized at fair value even if the acquiree never recorded them before. And for non controlling interest, there are two approaches to that. Either there are two approaches to that. Either NCI is recorded at fair value or NCI is recorded as a proportionate share of net assets in the acquiree. We will understand this comprehensively with the help of an example later. Okay, next step is to calculate the goodwill. What is goodwill? Goodwill is the extra amount you pay when buying a business over and above its net identifiable assets. Yani the extra amount paid by the acquirer to the acquiree when it buys a business. Why does he pay this amount? To account for when you acquire another business, that business was already settled, it had its own customers, its own vendors, its own suppliers. So you are buying that company, and that those vendors, suppliers, customers, you are also getting them. So this return that you are getting, this benefit that you are getting, this, for this you pay the extra amount, and accounting terms it as goodwill. So the formula of goodwill is as goodwill is made at what you pay minus what you get. So you pay this amount, you pay the purchase price, you pay for the non-controlling interest, you pay for the fair value of previously held interest. This applies when you acquire business in stages. We will also discuss that later. Minus the identifiable assets minus identifiable liabilities, or you also call them net identifiable assets of acquiree. So you, when you minus both these, you get goodwill. If this result come positive, it is goodwill, but if it is negative, then this is gain from a bargain purchase. Okay, so like I told you before, step acquisition or business achieved in stages. Okay, so a step acquisition happens when an acquirer does not obtain control in one single transaction but instead gains control gradually in stages. So, for example, okay, let's discuss. Let me just tell you. Okay, for example, initially A has 20% share of company B, and later it buys another 40% of shares of company B. So now total total is 60%, which is majority of the shares of B. So you see, it, suppose it did this transaction on 2001, for example, this is the year, and it did this transaction in 2002. So you see that the control was not achieved in the first stage, it was later achieved in the next year. So total 60% control was acquired in 2002. So now at on 2002, in 2002, this business will follow IFRS 3. Okay, so you see that con- hence now control is achieved. So IFRS 3 requires a special accounting treatment. Okay, let's. I think we should understand this better with the help of an example. Okay, I told you about that. Okay, let's see this example. Entity A acquired 15% of Entity B in 2009 for 10,000. In 2010, in the next year, further acquired 60% stake, and the consideration paid for it was 60,000. So how much was the consideration? We see it was 60,000. Okay. Now, entity A identifies the net assets of B as rupees 80,000. So net assets, we have already given the fair value of identifiable net assets, which is 80,000. Okay. So you see here, fair value of 15% shares. You see, like what I was talking earlier. You see, entity A acquired 15% of entity B in 2000 for 10,000. Initial value of shares was carrying value was 10,000. But at the time of acquisition, the fair value was calculated of, since entity A already held 15% of entity B, so fair value at the acquisition date was 12,500. So we will not record 10,000 here, we will record 12,500 here. This is the very important step that I was discussing while telling you about step acquisition. So you see that, just give me a second. Yeah. Okay. So you see that the acquirer must remeasure its previously held equity interest in the acquiry at fair value on the acquisition date. This is what happened. This is exactly what happened in our example. So you see the fair value of previously held interest, it is 12,500. Okay. These values will be same here. Now the purpose of taking this example was to help you understand two different approaches to NCI, which were measuring NCI at fair value or measuring NCI as a proportionate share of net assets. How will you, since you have not given any information about NCI, non-controlling interest. So you see 60 plus 15, 75%. So A already has 75%. So what will be the non-controlling interest percentage? That is 25% of remaining 100%. Got that? Okay. So when we calculate NCI as proportionate share of net assets, so what we will do, entity A, net, what are the net assets? Amount is 80,000. So what we will do, we will 25% of proportionate share of net assets, which is 80,000. So this will be the amount. Now we will add all these. So goodwill amount is 12,500 if you calculate NCI to proportionate share of net assets. Now if you calculate NCI at fair value, so you assume that for 60% stake, the consideration paid was 60,000. So for 25%, the fair value will be, like, since it is proportionate, so fair value will be what? It will be 25,000. So here you will write 25,000 as the fair value of non-controlling interest. So now when we will sum all of that, so you see goodwill here is 17,500. You see it has increased by 5,000. So this is the difference between calculating goodwill through proportionate share of net assets and calculating NCI through fair value. And in this example, you also got the concept of step acquisition, and you also got the concept of fair value of previously held in equity interest. So that was a very good example. Okay. Another concept. Now, what is a bargain purchase? So, in a bargain purchase, it is the opposite of goodwill basically. A business is acquired at a price lower than the fair value of its net assets. Like when you measure the total net assets of the acquiry, you see that it's more like that a company has diamond, but it doesn't know that it has diamond. So you pay less for that diamond, and then you acquire the company, and then the diamond, you get the diamond for its original value. Like you have that diamond, and you now can sell it at a higher price, and the company B doesn't know that. So it is like that. So you see that it is a very rare phenomena. Like it usually doesn't happen. Like no company is that dumb, to like sell their net assets at a lower price than the market value. So how the, like you see an example here. uh, Okay, the consideration paid when acquiring a company was 700, and its net identifiable assets per the calculation of acquirer were 800. So the acquirer had a benefit of 100. Like it didn't have to pay anything extra. Like on the contrary, it got a benefit of 100 million dollar, whatever the currency and amount is. So I hope you got the point. And it happens, yeah, like you see, it happens the when any business is going bankrupt. So you see, it is desperate to sell it. So when it is desperate to sell it, it can make such decisions. Or sale of business due to a regulatory requirement. Like for example, a business is and a Pakistani business is operating in China, and now the Pakistani government has imposed a regulation that no business, like any if any Pakistani firm is seen regulating its operations in China, it will be banned from operations. So you see that Pakistani firm will be now eager to sell it in China. So you see, it maybe then sell it for amount less than what was its original value. So now let's come to the core principles. Okay. Okay, let's discuss them one by one. Okay. So what is the recognition? What must be recognized at the acquisition date? So you see that acquirer and inquiry, the assets, the liabilities assumed, NCI, all of these must be recognized at the acquisition date by the acquirer. Now, IFRS 3 is mainly for the acquirer. For measurement, we have seen that all the assets, liabilities, and their measurement should be done at the fair value, and NCI can be measured at fair value or proportionate share of net assets, and the measurement is done on the acquisition date. Regarding presentation, so you see that assets will be held in normal headings like PPE or inventory. Liabilities will go to relevant categories. Goodwill will be shown as an intangible, and you see that what will be the income statement impact. Acquisition itself does not affect profit. Future depreciation and amortization will impact profit, since you are getting additional assets and liabilities, so their depreciation and amortization will also add up. Disclosure, so it will help users to understand the nature and impact of acquisitions, and what should be disclosed: name and description of acquiry, the acquisition date and the percentage acquired, consideration transferred, and the amount of asset, liabilities, and goodwill recognized. So what are the common mistakes? Common mistakes of this standard are treating asset purchase as business combination, using book values instead of fair values, incorrect goodwill calculation, okay, and ignoring the non-controlling interest, and missing the required disclosures. Finally, the key takeaways: IFRS 3 applies only when control over a business is obtained, acquisition method is compulsory, and goodwill affects asset quality and future impairment risk. Non-controlling interest impacts ownership and profit attribution, and disclosures explain the real economic impact of the acquisition. So together they help users understand what the numbers truly mean. Okay, this brings us to the end of IFRS 3. Thank you for watching, and see you in the next video.